This segment sponsored by Foster Financial. Welcome to Money Monday, where we provide you with holistic financial advice from Foster Financial. And joining me is their Vice President, Caleb Doane. Hello.
Hi.
All right, Caleb. I cannot believe it, but the year is almost over.
Yeah,
we have 2 more days.
Yep.
Okay, so during this time, there's so much that people are thinking about, but now that Christmas has passed, people can focus on what exactly they need to do to wrap up 2024, and that is with end-of-year planning.
Yeah. Yep.
Okay, so a couple of weeks ago, we talked about how people can do Roth conversions.
Yep.
And so now, what is the final step that people need to really focus on?
Yeah. So one of the other things that needs to be done by the end of the calendar year here would be tax loss harvesting.
Okay.
So if you want to do tax loss harvesting for 2024, it's got to be done by December 31st here.
Mm-hmm.
So I'd say this is a slightly more complex tool that we use at our firm. So there might be a lot of people out there who aren't familiar with it. But essentially, it's a way to manage capital gains taxes. And capital gains taxes are only for certain types of investment accounts. These are for investment accounts that you fund with after-tax dollars. You know, you're just taking money from your checking account and you put it into an individual account, a joint account, a trust account. These are the types of investment accounts that are subject to capital gains and therefore can benefit from tax loss harvesting.
Okay, and so as we talk about tax loss harvesting, does it apply to everyone, or is it a certain age range or certain type of account? Can we go into that?
Yeah. Anyone with a joint account, individual account, trust account, regardless of your age, you can still benefit from tax loss harvesting. And essentially what it is, for people who aren't familiar, it's basically offsetting a realized capital gain with a realized capital loss, so that you don't have to pay capital gains taxes. And so as an example, let's say at the beginning of 2024, somebody bought $1,000 of Apple stock and they bought $1,000 of Boeing stock.
Okay.
Over the course of the year, at least as of a week or two ago, Apple stock was up about 30%. Boeing stock was down about 30%. And so let's say somebody said, hey, Apple stock went up so much, I want to be able to harvest that gain and put it back in my checking account because it's gone up what I wanted it to go up and I want to get out of the market. Well, if they were to, but let's say they wanted to keep the Boeing stocks. They say, hey, it went down 30%, I want to wait for it to recover potentially. If they were to just sell the Apple stock, they would pay capital gains on that 33% gain for Apple, right? Instead, what they could do is sell both the Apple stock and the Boeing stock. The gain is offset by the loss. You would owe nothing in taxes. You would need to wait 31 days, and then you could buy back into Boeing stock. If you don't wait the 30 days, it has to be more than 30 days, so we just always say 31 or more. If you don't wait that, it counts as what they call a wash sale, and then you can't use that loss. And so it's got to be out of the market for a little bit, and then it can go back in.
Interesting. So what if someone lost more for the Boeing stock than they did gain for the Apple stock? They wouldn't have to pay any capital gains at all, is what you're saying, because the deficit is higher.
Right. And in fact, what you could do is if your losses end up being more, there's actually a certain amount you can write off of your ordinary income. So if you have an overall net realized capital loss in a given year, you can deduct up to $3,000 of capital losses from your ordinary income every year. And so that's certainly something we take advantage of. If somebody's in a year where they had a lot of income, maybe we realize some capital losses so that they can get that $3,000 deduction. Or in the scenario you mentioned, if Boeing stock was down more than Apple, maybe we only sell half of the Boeing shares. And that way, the losses actually even out. So.
Okay, so there's some flexibility in it. Okay, so we're talking an example about stocks, but can you give an example of another type of account that this could apply to?
Yeah, so I mean, there are a lot of different positions. Stocks are certainly one of them. Exchange-traded funds are another ones that can have the realized capital gain or loss. Mutual funds are another one. Bonds you could even sell, all inside those same type of accounts. That would all be inside of an individual account, joint account, trust account. But you can kind of tell this type of strategy can get a little complex.
Yes,
People,
it
if
sounds like
you're,
it.
yeah, if you're somebody that manages this on your own,
Yeah.
it might even be hard for you to see what your realized or unrealized capital gain or loss is
Right.
so far over the course of the year. With the software that we have, we can go in and look at every individual tax lot. Maybe you purchased Apple not all at one time, maybe it was over the course of a few years. And so we can strategically pick which position we want to sell to be able to manage your gains.
Yeah.
And so if you don't do this and you end up just selling a position that has really high gains in it, it can cause you a lot in taxes in a given year, which obviously we like to avoid.
Right. Okay, so we have to harvest our tax loss.
Yeah.
Follow it,
Right.
but not on our own. We have to do it with a financial advisor like you, Caleb,
Yeah.
to help us every step of the way.
Perfect.
Yeah, thank you. And if you would like more information about Foster Financial, we'll have their phone number listed below, and you can contact them for a complimentary consultation. And we'll be right back. This segment sponsored by Foster Financial.